What if someone told you that financial freedom is not a far-fetched dream but a reality you can achieve? Would you believe them? Picture this. A life where you're not living paycheck to paycheck, where you're not constantly worrying about bills or debts, where you have the freedom to live life on your terms. This isn't a pipe dream, a fairy tale, or a get-rich-quick scheme. This is financial freedom, and it's a reality that's within your grasp. Financial freedom isn't about being rich or having an endless stream of money. It's about having enough resources to live comfortably, to pursue your passions, and to have a sense of security and peace of mind. It's about not being a slave to money, but rather having money work for you. And how do you make money work for you? Through investing. Investing is the key to unlocking financial freedom. It's how you take your hard-earned money and make it grow. It's how you build wealth over time. It's how you create a safety net for your future. But let's be real, investing can be intimidating, especially if you're a beginner. There's a lot of jargon, a lot of options, and a lot of risk. It can feel like you're venturing into uncharted territory, but just like anything else, the more you understand about it, the less scary it becomes. That's why it's critical to understand the basics of investing. By learning what investing is, how it works, and how to get started, you can navigate the world of investing with confidence. You can make informed decisions about your money. You can take control of your financial future. And the best part? Anyone can learn to invest. It doesn't matter if you're fresh out of college, in the middle of your career, or nearing retirement. It doesn't matter if you have a lot of money or just a little. Investing is for everyone. The journey to financial freedom begins with a single step, and that step is learning to invest. Think of investing as planting a seed and nurturing it until it grows into a tree. The seed is your initial investment, the nurturing is your patience, and the tree is your reward. Let's break down the process of investing into some simple steps. Firstly, it's crucial to have a clear financial goal. Just like the destination on a road trip, you need to know where you're going. Are you investing for retirement, a down payment on a house, or perhaps just to grow your wealth? Having a clear goal will guide your investment decisions and keep you focused. Next, you'll want to research different investment options. Just like a gardener chooses which seeds to plant based on the type of tree they want to grow, you'll choose your investments based on your financial goals. There are countless options out there, from stocks and bonds to real estate and mutual funds. Each has its own potential for growth and risk, and it's important to understand these before you dive in. Speaking of risk, let's talk about understanding risk and return. High-risk investments often have the potential for high returns, but they can also lead to significant losses. Low-risk investments, on the other hand, are more stable but offer lower returns. It's like choosing to plant an exotic tree with the chance of it growing into a massive beauty, or a local tree that's sure to grow but won't be as magnificent. Your comfort with risk will greatly influence your investment choices. Now let's discuss the power of compounding. This is the process where your investment earns returns, then those returns earn returns, and so on. It's like a tree growing branches, which then grow more branches. Over time, this can lead to significant growth, especially if you reinvest your returns rather than taking them out. Investing is not about getting rich quick, it's about growing your wealth steadily over time. Just like growing a tree, it takes time and patience, but the reward is well worth the wait. Now that you understand the basics of investing, let's delve into the common investment options available to you. First up, we have stocks. When you buy stocks, you're essentially buying a piece of a company. It's like being a tiny co-owner. The advantages? When the company does well, so do you. The stock price rises and you can sell your shares for a profit. But the flip side is true as well. If the company doesn't do well, the stock price can fall and you could lose money. Next on our list are bonds. Bonds are like an IOU. You lend money to a company or a government and they promise to pay you back with interest. Bonds are generally considered less risky than stocks, but the potential for high returns is also lower. Then we have mutual funds. These are a pool of funds collected from many investors to invest in stocks, bonds, and other assets. They're managed by professionals, which can be a plus if you're not confident about picking individual stocks or bonds. But remember, these professionals charge fees, and these can eat into your returns. Real estate is another common investment option. Buying a property and renting it out can provide a steady income stream. But real estate also comes with its own challenges, like maintenance costs and dealing with tenants. Plus, it's not as easy to sell a house as it is to sell a stock or a bond. Finally, there are exchange-traded funds, or ETFs. These are similar to mutual funds, but they trade on an exchange like a stock. This means you can buy and sell them throughout the day. They also often have lower costs than mutual funds. Each of these investment options has its own advantages and disadvantages. It's important to understand these before you decide where to put your money. Remember, there is no one-size-fits-all investment. What works for someone else may not work for you. You've probably heard the saying, "Don't put all your eggs in one basket." Well, this applies to investing too. Think of diversification as a financial safety net. It's the art of spreading your money across various investments to reduce the risk of a single asset dragging down your entire portfolio. Imagine you're a tightrope walker. Diversification is like a safety net that catches you if one of your investments starts to falter. Diversifying your portfolio is not just about having different types of investments, it's also about having these investments in different industries and sectors. Why? Because not all sectors perform well at the same time. When one sector is down, another might be up. As the old adage goes, when one door closes, another opens. So, how can you diversify your portfolio? Let's break it down. First, you'll want to diversify across asset classes. This means spreading your investments between stocks, bonds, real estate, and potentially even commodities. Each of these asset classes behaves differently in different economic conditions, providing a buffer against market volatility. Second, consider diversifying within each asset class. For instance, within your stock investments, you might want to invest in a variety of sectors such as technology, healthcare, finance, and consumer goods. This way, if one sector is underperforming, it won't drag your entire portfolio down. Finally, think about geographical diversification. Markets in different parts of the world can react differently to the same events. By investing globally, you're spreading the risk further and potentially tapping into growth in emerging markets. Remember, the goal of diversification is not to maximize returns, it's to manage risk. It's about balance, about finding that sweet spot where you're comfortable with the level of risk you're taking on while still aiming for a solid return. Diversification doesn't guarantee profits, but it can help you spread your risk and potentially increase your chances of earning a return on your investments. So, are you ready to take that first step towards financial freedom? We've covered a lot in this video, so let's quickly recap. We started our journey on the road to financial freedom, discussing the importance of taking charge of your financial future. Next, we delved into the basics of investing, emphasizing how crucial it is to understand the fundamental principles before jumping in head first. We explored common investment options, highlighting the benefits and risks associated with each. Remember, there's no one-size-fits-all when it comes to investing. It's all about finding what works for you. We then talked about diversifying your portfolio. This is a key strategy to mitigate risk and maximize potential returns. It's about not putting all your eggs in one basket. Investing is a journey. It requires patience, persistence, and continuous learning. But remember, the goal is not just to make money, but to achieve financial freedom.